Back in the day when Indian healthcare was still so virgin, you could have very conveniently chosen not to do that.
People would look at FMCG and for healthcare and say these are recession resistant or recession proof. I think things have changed. Pharma at a $50 billion market, 300 companies control 80% of that market. Just to give you an idea, the outpatient market or the primary care market is 5x of what the inpatient market is. And that market is just starting off.
You're riding at a time where India has seen affordability go up. India has seen awareness on health go up. But access is still a challenge.
When I look at a promoter, this is the question I always ask is, oh, you want to build in the lower tier? How many days are you ready to spend in, say, interior Maharashtra?
From the top 200 districts going to the middle 200. How are you even finding deals there? Good afternoon, Mayur. What a pleasure having you in another episode of Two GPs in a Bar. I wish the setting was more like a bar, and I wish we had a drink here rather than water, but nonetheless, it's always a pleasure chatting up with you. So I think the first thing I can ask you, Mayur, and it's been a while we have now gotten to know each other, but I think still for the benefit of everyone, tell us about what landed you into the space of private equity investing in healthcare in India. You've seen quite a bit, so would love to know what landed you in this.
Thank you, Rohit, and thanks for the opportunity to be here. I think for me, healthcare has always been a passion. I think as a family, we've been in pharma and healthcare for decades. And even though I got educated as a chemical engineer, I gravitated to pharma early in my career and have been sort of in pharma and healthcare throughout. So I think one was the fact that this was a natural progression. I had done my own manufacturing-based entrepreneurial stint. I had done professional stints in healthcare. And I think this was sort of a culmination of saying, how can I really put all that together to make it work? But also, I think healthcare overall, our reading is that healthcare is a extremely strong growth sector. Uh, Earlier, like we said, people would look at FMCG and for healthcare and say these are recession resistant or recession proof.
Right.
I think things have changed. I think today healthcare is a booming sector. I think post-COVID probably more so because areas like preventive care, people wanting to really look after their health. I think things have changed. India's growth in terms of per capita and the affluence which it has created also has led to what we saw in the West, right? Healthcare as a percentage of GDP is fairly large in Western markets or even in Southeast Asian markets. I think we are seeing that trend starting. We're also seeing trends where we're seeing insurance and payers coming in to look after healthcare, which helps support healthcare in a big manner. So I think all these things show that healthcare is moving in the right direction. And I think for us, and for me especially, I felt that this was a space to build out on and actually create companies which were valuable. We were basically looking at operating businesses to build up. And the more we looked at it, we said there are enough promoters out there. Can we do something different? And that's where the idea and the germination of the fund came. So actually, our first investment was pre-fund, where we had found a company which we had liked. We said we'll support, and then we said, why don't we really institutionalize this effort? And I think that is where the whole idea of the fund came in, saying that can we get in? Can we not just provide capital, which was definitely required at that point? And when you're talking of 10, 12 years back, the market was much smaller.
Yes.
Companies were 20, 50 crore size, were the SME kind of companies. We felt that was the right spot of putting in 25, 30 crores, building them out, but not just building them out. The critical part for us was always, can we bring our healthcare experience to bear? And I think that is what we've sort of strived to do. That's the philosophy which we've used throughout.
So Mayur, 2011, which is when, like you just said, from when it started to keeping the thesis consistent to being literally the first institutional investor in these, at that time, small and medium-sized checks, small and medium-sized companies, to today, where obviously they still are small and medium-sized, but the size has become bigger, right? India has become bigger.
True.
So you are staying true to that strategy. Also, what I kind of take out when I think of you is, you're riding at a time where India has seen affordability go up. India has seen awareness on health go up, but access is still a challenge, right? So that's what you're plugging in, really.
True.
So tell us about that.
So I think what you said is very true. I think what has happened over the last decade, let's take a decade of this, is the Indian economy has picked up significantly. But I think healthcare also has picked up extremely well. I mean, where we started out in 2011-12 at $80 billion,
Right.
out of which predominantly it was pharma, to now in 10 years, we added $300 billion to that. And in that, not only have you seen pharma, but now you see the whole craze around hospitals and the listings in hospitals. That's become a big sector. But even beyond that, I mean, other subsectors which are fairly small, which was diagnostics, COVID really changed that around. MedTech, now that hospitals have gone in scale, that is picking up significantly. And the new area which is really emerging is the primary preventive care sector, which in India was non-existent. It's a self-pay market. People got themselves treated when they fell ill. Today, I think we're going into a very different paradigm of saying, can we look at diagnostics? Can we look at screening? I think that whole builds out a market which probably, just to give you an idea, the outpatient market or the primary care market is 5x of what the inpatient market is. And that market is just starting off. So the biggest thing which has changed in the last decade is finally the advent of payers. So I know you said three things: the access, affordability, and awareness. I think awareness, things like COVID created.
Yes, very true.
Affordability was always a challenge, and that's why you didn't have deep healthcare penetration, right? Lower tier markets or lower economic strata of population couldn't get access to healthcare. That has changed. I think Ayushman Bharat, the
Yes.
PPPs, even the private insurance now has started penetrating deeper to the point that now the first time you're seeing out of pocket being lower and the payer mechanisms being higher. And I think that definitely shows a shift. We're moving to the whole reimbursement mechanism. But I think these two things. So now what do you have? You have awareness going ahead. You've got the affordability created, but the biggest issue is access.
Yeah.
I mean, how do you create access? And I think what we have done through our investments across the spectrum is use capital to create both physical access as well as technology-based access.
Brilliant.
Because you can, even today, what we are really covering, even when we say lower tier, is out of the 700 districts in India, probably beyond the metro tier 1 200, you're covering the next 200 250. We're still not even getting to the last
Very
one.
true.
And I think that one requires a very, very different story.
Yep.
But even in this, to really create significant access, I have to use technology like teleradiology, telepathology, tele-ICU, to go and sort of where doctors can never go.
Yeah.
And I think that combination is what we are looking at. Whether we did it in, say, Krishna Diagnostics in the teleradiology space, or Apex Hospitals, we've done a tele-ICU network to reach about 40 plus sort of ICUs in very, very lower tier districts. I think that is what we work on. But what has really helped us is the combination of access, but understanding how to work with affordable mechanisms. Because now you're talking of institutionalized mechanisms like Ayushman Bharat, PPPs, private insurers. Learning to work with them is also a big experience. I think both these combinations is what really drives healthcare. I think
Very
that's
true.
the main thing.
And as you talked about, from the top 200 districts going to the middle 200, let's just, top, middle, bottom, you're focused on the middle 200. And there, that access is even more broken, right? How are you even finding deals there? How are you finding, because you're going into a bold, brave world of being the first institutional investor in
True.
most of the deals you go into. And that needs a level of domain clarity, thesis clarity, founder comfort, all of those things. So I'm just very curious to know, how do you cultivate that?
So I think over a period of time, we've sort of understood what it takes to build in this market, and we look for those kind of people. I think the critical part is finding the right founders. We do spend a lot of times creating proprietary deals, or even if we have a bank deal, we will make sure that we spend time working with the promoter, understanding him, because these are not easy markets to get to. I mean, a person like you and me sitting in Bombay or Delhi, how often are we going to go into these markets? We may go maybe once a month,
Yeah.
twice a month. These guys have to spend a whole month there.
Yeah.
And I think that is understanding that feature is very important. And I think when I look at a promoter, this is the question I always ask is, oh, you want to build in the lower tier? How many days are you ready to spend in, say, interior Maharashtra? Because that decides whether he's
Indeed.
really going to go there. And that is the promoter you want. You want a restless promoter who will keep going into those markets. And that's the moat. Because if that's the guy who goes vis-a-vis somebody else who says, I'll send somebody else to do it, that is the what you will. So I think the critical part is finding the right promoters who can execute in lower tier markets. I think it is, if somebody does well there, it is very difficult for somebody else to go in and replicate. And we've seen this and I always use this example as Mankind Pharma in the pharmaceutical sector. I mean, being from pharma, we have seen how Mankind went from a nobody in 20 years' time to the top 5 of Indian pharma. And you saw the IPO which they created, right? It's that. I mean, if I had to say in some other ways, we are trying to create the Mankinds in diagnostics, the Mankinds in hospitals, because everywhere the concept remains the same. You need a promoter who uses systems, processes, and whatever is possible on the ground there to create a business which is at scale, but which is so difficult for somebody else to come and replicate. And I think that is what we really, really look for. And so the secret sauce, which I really say, is two things. One is finding a promoter who is restless and passionate, but who's also extremely resilient. It's not easy in these markets. So if you are, unless you, and you'll see different vagaries play out. If he cannot adjust to that, he'll never succeed.
So nothing is easy, Mayur. If finding them is not easy, being perseverant, working with them is not easy just because they're geographically everywhere. But you kind of stayed with that thesis. Results today are proving themselves. I was looking at one of your examples, portfolio company examples, Krishna. You did twice the revenue in half the time compared to a comparable peer, which was only focused on tier 1 cities, tier 1 towns. So your tier 2, tier 3 is clearly proving that it can really outperform compared to tier 1. You've proven it now. But going in, back in the day when Indian healthcare was still so virgin, it's still massive and virgin, you could have very conveniently chosen not to do that. Was there a inner passion? Was there something bigger which drove that you just want to be focused on so much on that gap?
So I think we called that, Avinash and I, when we looked at healthcare in India and said, how can we are coming in, we are to that extent unknowns when we started out. What do we differentiate ourselves with? And we felt that there was this space which nobody else had addressed. We had seen in pharma some of these successes, like I said, of Mankind and few others. We said, there is an opportunity to do this across healthcare. And that was what really drove us to say, let us look at this segment. It's not going to be easy. We have to create our own models. And what we've done over the last decade is actually created things which were not there on the ground. I mean, Krishna today, exactly what he said. I mean, it was when we started out, PPPs were just starting. Nobody knew how to operate these PPPs. We had said, let's dabble in it and see. And if you had to see, Krishna's plan that time had probably only 20% of that was PPP. The rest was regular traditional. We flipped that around when that happened. But we learned to execute at scale. The biggest thing which you have to learn in this market is execution at massive scale. The government or that market demands a price point which is much lower than the traditional markets. But it gives you probably 3x, 4x of volumes, right? Now, which means execution is.
So your unit economics are leaner, but if you master that, a lot more volume is going to flow to the bottom line.
So the critical part there is working with volumes, executing at scale, but understanding cost structures. Like you said, it's lean, but then you need to keep your operations lean and work that. And that becomes a critical part of this. So that is if you really ask me, this is exactly what we've done. Execution at scale, but understanding cost structures to really make sure that it's a profitable business at the end of the day. I mean, we like the theme which is played out now with people say, with good returns with social impact. I think that is what we truly play. We do social impact for sure, but we make sure that these are strong returns and pretty much better returns than even you get in traditional markets.
Right.
So I think that is what we play for.
Fantastic. And you've continued to be pretty much a part of all the subsectors of healthcare, from pharma, even being comfortable with backing founders when they're getting into brownfield or greenfield carve-outs, That comes with time. That is not easy to do. Are you doing more of those?
Yeah, I think
Those
for us,
spin-offs and those carve-outs?
so now I think the way when we get into a business, we look at, and now that we're at a little bit of a different scale, I think there are two things which play out. One is obviously the organic growth, but we also look at the inorganic growth. The biggest thing which has changed in the last probably 5 years, or probably post-COVID, is the availability of inorganic opportunities for growing. Because in healthcare, there are people who see growth and can get to the next level of scale. There are people who are now saying, "Oh, we've run till now, and I think we need to step off," and they are ready to sell, because a lot of times, especially in hospitals, next generations are not becoming doctors, etc. So you see those kind of opportunities. So I think at the scale at which we are now, we can see much more growth happening because both engines run,
Right.
the organic and inorganic.
Right.
I think that sort of plays out well for us in terms of what we're really looking for.
Now, coming in as the first check, you're almost kind of going to get very emotionally connected with your portfolio companies, with your founders. You're almost like a joint venture partner with them. You're the first institutional check in them. Yet, Somerset has somehow figured out a way to keep an eye on exits. And you kind of do it quickly. You 3-4 years onwards, something starts happening. Your clock starts turning on. So how do you keep that dispassionate duality to the whole thing?
So I think the critical part for us is we look at an exit when we enter, or even before we enter. So whenever we go in, we make sure that we understood what our potential paths of exits are, and that we discuss with the promoters head on. It's not saying, okay,
at the point of entry.
At the point of entry, because a promoter can be two things, right? One is he can be somebody who's a little older. He could be somebody who's much younger, or maybe I say second generation coming. You need to look at things differently.
Mm-hmm.
And we will. So our typical points of exits are what? It's going to be a second round from another financial investor. It's going to be strategic, or if it do really well, an IPO. And probably in this fund, we'll probably see more of that too. But you need to discuss that, because each promoter has a own understanding of how he wants to look at an exit.
Correct.
Discussing that and being comfortable with it is important. I think the second thing is, like you said, when we get in, because these are sort of newer businesses or in different markets, we have to spend a fair bit of time making sure the promoter understands how to build an organization, a systems and process. These are homegrown promoters. They've done things on their own. They've built these companies to 100 and 200 and 300 crores on their own, without any capital.
Right.
They're proud promoters. Now you're telling them, you have to build it to 1,000, but you need so many people under you. They may not agree. How do you keep pushing that make sure that because what we've seen always is promoters will come back to you one day and say, my personal bandwidth is over. Now I understand what you're saying.
Yeah.
But you have to keep pushing for it from day one. So I think a lot of what you're executing over 4-5 years, but all that thing has to be thought up front. You have to get a buy-in from the promoters, because then that journey is smooth.
Right.
If you're just going to push it at halfway, saying, okay, now you do this because I just want to do it. No, you have to basically get to that. And my thing is, promoters listen. They may not do everything upfront, but they listen. And they listen very hard, and they will do it when the right time comes. So you just have to keep at it. But I think that planning the exits early and saying each company what is the potential possibilities, I think is important upfront. So then there's no dissonance when you're really looking at an exit.
Yeah.
And I think carving out, it's different. I mean, we've seen so many times that we built a company and then suddenly seen another opportunity where say, why don't you look at that? Even the new investment we've done in our medical equipment servicing business, they're an India-focused business. But we see a very big opportunity for them. They were a Middle East partner. I was in Dubai a month ago. I see a big opportunity to build it out there. Now that part is not even in the business plan.
Yeah.
So I think these are important things to understand. What do you really look for as you move forward? Because you build a business plan 5 years ago. It's not going to stay static. But are you flexible enough to work with the promoter, but hold and work hand in hand? I think the critical part is, and this is something which we do effectively, is we tell the promoter, we are here for you. You tell us where you want support. We are not going to come in and barge into your activities, but wherever you need support, and a lot of it is in sort of newer areas.
Yep.
We will step in, not just through our internal networks in India, but even through our external networks overseas. I think that combination, and I think that's what has driven a lot of promoters to come to us.
Is some of that, call it inorganic, call it new areas that you're kind of enabling them with, are some of those becoming possible strategic options tomorrow as these promoters and you look at exits?
They do.
They do.
They do.
And therefore, it's a kind of a win-win-win for everyone.
True.
For obviously you, the founder, and for the incoming strategic partner who tomorrow might have a stake in the whole thing.
True. So I think it's important to sort of see. So we've done this in the past. In our first investment in Sandor, Avinash and I had looked at actually dialysis as a business even before we sort of formed the fund. In Sandor, they had a dialysis supportive business in terms of reprocessing of systems, but they had the network. We said, why don't we create that? We've done, and we created it successfully. We actually got another fund to invest behind it, and then we sold it to Fresenius. I mean, this was a completely non-sort of core area for him at that point in time, but it gave him a very, very good sort of business to work on. And we've done that significantly. So we did that in Prognosis with our telemedicine business, which basically Malbio bought out for this whole screening sort of exercise. So we've done this several times in terms of saying that can we create newer offshoots of the existing business, which were probably not thought of, but something which came about in that. Now, even in Fund 2, we are looking at actually 2 of our pharma businesses being merged together because we find that to be a better opportunity. They're very complementary.
2 different portfolio companies.
But over a period of time, we've seen that they're very complementary. We've talked to the promoters to say, can we build them together? Now, these are the things which we'll give.
What a wonderful example.
So I think, so we constantly look for something which will accelerate growth. Obviously, for us, it accelerates exits, but it also gives the promoter something different to look for, which tells him that, we are here as true partners and not just as sort of providers of capital.
Right. You're actually a joint venture.
Yeah.
Now, you did, if I'm right, 4 MOIC, multiple invested capital on Fund 1, and almost 3 DPI. That's incredible. But have you set too high a bar for yourself for Fund 2? Or are you good?
In a way. But I think where we operate in and in the lower tiers, we see that alpha coming in, and you need to pick your bet. So though we create a portfolio which traditionally will give us sort of 3x kind of returns, but you look for 1 or 2 of them. Like it happened in Fund 1 with Krishna, right? I mean, it was a real hit at a different level. I think we look for those, saying that can you build 1 or 2 of these in every fund? Because these will sort of take you to another level. But we also do the reverse. So one of the things which we also look at is a 0 loss ratio.
Yeah.
So we have 0 companies which we lost, but not because they haven't done badly. We always step in to change things around. So a great example was for us was our Cygnus hospitals. It is a learning experience for us to do that, not because of anything, but it was lower tier hospitals which nobody else had done. We were learning on the way. Yes, we did our mistakes. We went to the point of bankruptcy, but we picked it up, brought it back again to the point that we sold it to General Atlantic at 4x return rate. Now, you're talking of over a 10-year journey, understanding how to work the lower tier, but also being able to take a company which is completely in a mess, turning it around, putting some more capital, putting in better people, and turning it around to make it happen. And that is what we strive for. So I think if you see what gives you a better MOC or a DPI is, one is getting those 1 or 2 alphas in place, but also ensuring that you have 0 losses. Then your averaging basically reaches that.
So from your fund construct, therefore, Mayur, it becomes very important. While for a VC fund, having follow-on capital is largely opportunistic. For you, having follow-on capital allocated to your portfolio can actually, because they could land up in down times. Absolutely. And you really need to be, you are the only one and you'll be the only one at that time turning them around.
No, I think that's, if you really ask me, one of the biggest learnings for us over the last 2 funds has been having follow-on capital.
Yep.
It changes fortunes of the company. I mean, either you're taking a company really down in the dumps, you bring it back up, you need follow-on capital. Yep. If it's doing extremely well also, you could go to a very different trajectory. And that is what happened in Krishna, where We got in some follow-on. We could put in some between us and our partners, and that took it to a very different level. So that is the critical part.
Right.
I mean, because typically a promoter otherwise takes over a year trying to get that money,
Right.
and it's
distractful.
Basically, it's distractful. His bandwidth is consumed somewhere else. So I think that so this fund, we have decided at least 15% to keep as follow-ons and be disciplined in it to just keep it as follow-on, because that becomes important.
Yeah, no, that's great. That's really nice. And the way you're playing out all the three fronts on your exits, from strategic exits to secondaries to even leading companies into the IPOs, those three fronts, obviously with India now really opening up and India's exit or monetization of private market assets happening in a much more predictable fashion than they've happened long ago, is understandable. So I kind of find you now shining when India is shining, but you were also shining when India wasn't shining that much on the exits front. How did you, back in the day, when you were getting your institutional investors, inspire confidence? Because for them, they hadn't seen too much success coming out of India on exits. Now they do. Now I understand.
True.
But back in the day, and you are largely held, your LP base is largely institutional capital. So how did you inspire them?
I think basically showing them that, we understand how to, I mean, exits are opportunistic, obviously, but working towards them and building the company in that direction is important. I think we've always worked with that motto in mind, and I think that's what probably got institutional investors excited. We also managed to sort of, in Fund 1, get a couple of early exits, which helped definitely raise Fund 2, but I don't think there was enough DPI in Fund 2 in Fund 1 for Fund 2 investors to get comfortable. I think what we really showed them is our ability to not just build companies, but build them with a focused way of getting an exit. Also, I think the ability to turn around companies and the ability to spend time with companies, and that has been sort of corroborated by all promoters. I mean, today, whenever we deal with a new promoter, I think the best reference is an older promoter. And we say, why do, and they do talk to each other. So even if we don't ask them to talk, they will talk. And the reference they get is, no, these guys step in. These guys step in to support us. These guys step in to change the trajectory by if required. And they're always there with me to work things around. I think that, and they're patient. The critical part in healthcare is, and I think that is where having a sector-specific fund makes a difference, especially in healthcare. Healthcare is highly regulated, has a lot of things related to clinical access, etc., and clinical regulations. You need a investor who understands that. You need an investor who's patient.
Truly.
Because it does take time. I mean, you're building a manufacturing plant. In any other place, you build a manufacturing plant, you start from day one. Here, you need another year and a half to get regulatory approvals in place. It's a very, very different play. Yeah. So you have to be patient, and I think that's critical in that. And I think we've managed to demonstrate that to our institutional investors.
Oh, that's great. Also, I think what you've been doing with knowing upfront when you're coming into a company that you're not just setting an eye on the exit, but you're also bringing in partners who tomorrow could be investors, could also be partners to whom you could be exiting, and therefore developing a strategic roadmap of the company. You're giving a lot of predictability to the company's course. But that also comes in with a lot of board participation, a lot of governance management along the way. So is that something which is set as an agenda right in the beginning when you're coming into the companies?
Yeah, I think for us, it's very important to have the whole governance and piece. So we are ESG governed. We've extremely strong policies on ESG. So all our companies actually go through a diligence of ESG as part of the regular diligences. So we literally start from a screener in the ESG space when we look at a company, to doing diligence, to creating a policy, to really monitoring it. So I think that piece is constantly being handled across the life cycle of the investment. But I think we spend time with the promoter explaining to him the importance of this, because one is putting a policy in place or a framework in place saying that you need to do it, but how does that help you in terms of building your organization? Because finally now you're looking at taking these people from maybe 100, 200 crores to 500,000 crores, right? It's a very different organization. You need to get other people with scale in it. You need to make sure that, there are people from different organizations who can bring in that sort of flavor in it. So promoters need to understand that they need to change themselves, right? I think that is what we focus on a lot. And right from beginning, so things like putting in systems and processes, the internal external auditors, putting in a CFO, all that is part of our documents anyway, but putting it down, but in a manner which is supportive to the promoter, I think that becomes critical. You force all this down,
Yeah.
he's not going to buy it. But I think work, and like I said, it requires a little bit of patience to put it in place. Nothing's, though they listen to you, it'll take a year to do it, but fine. We know that experience that it works. So I think
Right.
it's just playing that, but living sort of with that in mind constantly.
Right.
Because it is going to help them when they're looking at an exit, and whatever that exit is, it's an IPO, they need to be so much more ready in terms of that. I think all that prepares themselves for that. So I think that makes a difference.
Got it. Got it. So, Mayur, now when we look at a sector as potent as healthcare, the country as a whole is growing at about 7%, let's say, or per capita GDP is growing at that basis. Healthcare is growing at about twice. Healthcare spend is growing at about twice that rate, which means, let's say, 12, 13. Healthcare spend at a sector level is growing in their late 20s, early 30s. I guess numbers are anywhere between 400 to 600 billion over a 5-year period, or even shorter, right? So this is an insane growth. So when a fund like you delivers a gross IRR of 25 to 30%, is it fair for me to say it's no big deal? Because there is a momentum. You have all the tailwind supporting you. And therefore, when somebody is looking at you and saying, okay, here is Somerset, and they're delivering 25 to 30% IRR, that's par for course.
I think it's, like I said, healthcare, you're completely right. It's growing at a very phenomenal pace. I think it's no longer a recession-resistant sector; it's a growth sector.
Yeah.
So that has been completely proven to the point that today it is not sector-specific, but all the sector-agnostic funds are also in a when other sectors are growing, they're still investing in healthcare.
Correct.
So that story is definitely playing out. I think, but the critical part in healthcare is again execution. What differentiates one company from the other is the execution capability. Again, execution is the team. I think understanding that is what really drives. So, though the like you're completely right, even the pharmaceutical sector, which is probably the largest, is growing at 12 and 14, 12%. You're seeing a very different play in terms of growth, but to get to that growth, you need executors on the ground.
Right.
And I think that is what you're really supporting. I think that is what we focus on. You may get a 25, you may get even a 35% growth. But the thing is, only if you find the right promoter who can execute. Because it's just that. It's I mean, if I just give you an example of pharma and take it forward to others. Pharma at a $50 billion market, 300 companies control 80% of that market. A fairly large nobody has a large market share. It's not like one guy has a 50% market share. So it's all about who can execute better than the other. And then you've got another 10,000 who are sort of the tail.
Correct.
So it's the guys who can execute better who will basically deliver.
And that's where averages hide the reality.
Exactly.
So the point you're making is, if the sector is growing, let's say in 20s, there are many who are growing below and there are many who are growing above, and execution will make the difference.
So you need to pick the guy who gets to that execution level.
Completely. Oh, wow.
And very, more very so relevant. In the lower tier, because in upper tier, it's a lot still of traditional models where you are still taking market share from each other to a great extent, though the market is also growing. Lower tier, it's market creation. It's complete market creation. So if you are not there to execute it, you're never going to get there. Because you're not copying anybody's model. You're creating your own story at that point.
Right. How does it feel? Fund 3 is off to its first start. I believe you just committed an investment as part of the third fund. How does it feel?
It's good. I mean, I think it's a reiteration that what we are putting together is going, because the investment, again, we're the first institutional investor. It's a medical equipment servicing business, again doing public sector and private sector, very much within our thesis. I think a much bigger check. I mean, we're putting in nearly $16 million. We'll probably put in another 10, 15 million more as time goes on. So what we've sort of set out to do, saying that we are raising a larger fund because the market is scaled up.
Yep.
We're just tracking the market. We basically saying that because of the market scaling up to this level, we have moved from a $5 million check to a $15, $20 million check. And I think that is what we're proving. I think the thesis has remained the same. Our thesis is access to affordable quality healthcare. We're consistent with that. We're consistent with our impact story. I think it's just that we are looking at larger sizes of companies because that's how companies have evolved. It's heartening to see that what we looked at a decade ago at 20 and 50 crores, the same guys are at a 200 and 300 crore level now. And I think that's what we are tracking. And we see many opportunities. I mean, though we've done one now and we'll probably do one by March, April, we see many opportunities across subsectors which will sort of meet our sort of thesis. So I think it's a good time to be in healthcare.
Absolutely. I can see that. Also, you stay true to what you are. I think you're loving that. You're playing in a sector which has consumption all across. It's riding the India growth. You've battled it out on the exit fronts, which is clearly a strength. You've deployed almost 250 million between your own investments and the co-investments.
Sure.
And you have another 300 million to deploy as part of your investments and co-investments out of the third fund. So at about $550 million, you are one of the most serious players in the healthcare scene. So congratulations to that, Mayur, to you, to Avinash, to Ramesh, to the whole team. I think it's incredible what you guys are doing. Also, I think you're benefiting with three things coming together in India at this point. You have tech enablement, policy enablement, financial enablement.
Sure.
How often does that happen? So kudos to being at a great point of time. Kudos to a great journey thus far, and congratulations for everything you have achieved. And
thank you.
Best wishes for a lot more to come to your way.
Thank you so
Thanks
much.
for joining us this afternoon.
Thanks, Rohit. Thanks. I appreciate it.